All right, welcome to the call, guys. I see Adam's on. I see iPhone Mark. That's a good name there, iPhone Mark. Season. Brian's on. Got some more people hopping on here this morning. D, hi D, how you doing? Good morning. Good morning. Thanks for being on this morning, guys. It is we got fall here in Northwest Indiana, which is good. Me and my wife love the spring and fall seasons. It's our favorite time of the year. Good morning, Alicia. We got lows in the high 40s and highs in the upper 60s, and the leaves are starting to change, and it's just beautiful. I love this weather. I grew up in construction, so this is the weather that you don't sweat as much and you can work hard on. So it's good to be here this morning. The Lord gave us another day to work hard and serve Him today. So welcome, Mark. See a couple of people on their cell phones on this morning. But my team gets on before these calls, and we kind of do a marketing I don't know, check in for the month and kind of figure out how to continue to do these calls and our meetup group and our free for all event. And all of it's really just to build community, help people, and also kind of help me with my goals, which are to flip the city of Gary, Indiana, and to give away $1 billion in my lifetime. I kind of feel like that's why God placed me on this earth. So I'm glad that you guys can be a part of that. Let people know about us and let people know about what we're doing. I'm going to share my screen right here and just kind of get going just a little bit as we get going this morning. My Amelia helped me with this call here, or with this PowerPoint, and I forgot to add the book. Oh man. Oh well. Or maybe we did, and I forgot to open up the new email. But welcome everybody. Thanks for being on. If you guys weren't with us last week, we talked with Augie Bylot, who was with us at the Free for All event, and we raised about $85,000 for Share the Love at the Free for All event. And he talked about trust and talked about real estate and all the stuff that he does, that he kind of has used through the years to work to have, and then now he's kind of spending his later parts of his life giving. And I love Augie. He's a great guy. But today we've got two amazing people, David McAlvany and Tory Aggeler. And again, I forgot the book, and I normally have a book with me, but I gave away all the books I have at my office here at the Free for All event. I got one at home as well that I keep with me, that I read, and also David McAlvany's book. I just want you guys to know, like, this is a book that I even had my kids listen to in the car on one of our last vacations. So if you guys haven't gotten Intentional Legacy by David McAlvany, it's also on Audible. So I actually had my kids listen to it in the car. We always use our car time on vacations as a way to be able to teach our kids things and try to give that legacy and live out the legacy, but teach the legacy when we're even in the car. We've read Richest Man in Babylon, the Richest Man That Ever Lived. We've done a lot of those. We've even done Rich Dad, Poor Dad. We've done books like that I believe are a good time for those kids to kind of hear those things and not just hear. And music's great. Talk radio is great, but also kind of putting those things. And David McAlvany's book made it to that list for me. Like, I read it and I was like, my goodness, I got to get my kids to read this book. It's probably gonna be one of the books that I would have my team read as well. It does come from a Christian worldview, and I really appreciate that about David. And also, we're going to hear, and he's probably going to talk about legacy a little bit in his time with us today. But really, I've asked him to talk about economics. This guy has got an economics brain like nobody I've ever met before. And then at the end of the call, this call will go a little bit longer today, but Tory's going to give us an update on precious metals. I know the gold to silver ratio is kind of a little bit out of whack right now. So I'm excited to hear from both of them. You guys, Tory has been with us in the last two Free for All events, and he's enjoyed being with us, and we've enjoyed having Tory as well. You guys will have a good time with Tory as well. So me, since last month, I did go over this a little bit on the last call, but it was my wife's birthday and my son's birthday as well. So we had a good time with them. Got to be on our radio station for our church twice, and I'm actually going to be on again tomorrow morning. But I got to be on with my son, Zach, and a guy that works for me named Scott Dorsey. And then these are some pictures from the Free for All event, and some more pictures from the Free for All event. So want to just kind of remind everybody about that, and remind everybody about the 405 wheelchairs that we raise money for. And then upcoming, a couple things. I do want you guys to pray for me and my wife. We're going to be leaving Saturday to go on a journey in Greece. We start in Athens, and we are going to be doing the steps of Paul. So it's a biblical journey that we're doing for about 10 days there. So we're going to be touring Greece, and I've heard that Greece is amazing this time of the year. So we'll have fun. I've worked super hard this year, and I'm glad that we get to go. But for travel and all that, if you guys are interested in a real estate cruise, a cruise with a bunch of smart people on it, February 11 through 18. There's a lot of people in my network that I promised them I will promote for them. I don't get anything out of this promotion, guys. So we had about 5 people, I think, sign up for this at the Free for All event, but it's just something I try to help my friends out. So investoraddicts.com, you guys can find out more information there about that cruise. I promise you, I've been on about 10 of these investor cruises over the years, and it's a good time. Next, I talked about that last time. We're going to skip that this time, but if you guys are interested in the Free for All next year, it's going to be September 5 through 7. That's a Thursday, Friday, Saturday. And there's the QR code. You guys can find out more information about that. We are doing 2 for 1, or not 2 for 1, but we're a little bit of a discount with 2 different people. So if you guys are interested in that, you guys can sign up for that. I wanted to show this to you guys again. This is going to be the last time we show this on this call. But these were the have and want boards from the last meeting. So take a picture of these, zoom in. And if you're looking to do deals, if you got money, or if you're looking for partners, zoom in on these and get that information that you guys need for that. Also, we have the videos from the last event up and ready to go as well, goodsuccess.com. You guys can order the videos from the Free for All 2023. And honestly, I've never had people say this about one of my events, but I had 2 or 3 people come up to me and say, this was the best event I've ever been to. And we really did. I know we put on a good event at this last event, and I hope to see you guys there next year. We're going to do a quick video, and then we'll get on with our call.
Start here with the money multiplier. And I have honestly met a lot of folks that I can even expand my own real estate ventures with. And now I'm creating these relationships that I'm meeting here at Good Success.
Hey everybody, Tom Berry here from Houston, Texas. I represent the ILS companies, and here at the event, this has been an incredible event. They had a packed house with really good quality people. We've had some really great conversations, so I am sure we're going to do a lot of business with the folks here in Indiana.
Kelly, REI mom, and I am so happy to be here with Tom Olson at the Success Free for All conference here in Gary, Indiana. I highly encourage you to plug into Tom's network and plug into the Free for All monthly meetings. And I've honestly met a lot of folks that I can use my own real estate ventures.
I'm sorry, I think I stopped this. So let's just move on if I can get past this thing here. Oh, come on. I think we got through this thing. So come on. All right, you guys got the gist of that. So real estate Free for All Facebook group. If you guys haven't joined it, go there and join, and we'll just have some more conversations there. Remember, everybody, to be a conduit, not a bucket. Work to have to give. Live your life like God's placed you on this earth for a reason. Figure out who you can serve, who you can work to have from, and then who also God placed you on this earth to have to give to as well. And I'm excited about what God's let me to do. I'm actually going to be also going on a missions trip here to Guyana in November, and then another one to Guatemala in December. And then I'm looking at Ghana, believe it or not, in February. And then I'm also helping our teenagers. We don't know where we're going yet. We've had two kind of open and close doors with the teenagers for the seniors at our school that we've been doing a missions trip slash senior trip with, and we've kind of looked at Dominican. They kind of almost looked at Tanzania. We'll see. I think both those doors are kind of maybe a little bit closed a little bit. So you guys pray for us and let me help us figure that out. We have raised about $5,500 for them towards my goal of $25,000 for the seniors there to help them be able to go on that trip. So if you guys are interested in that, let me know as well. I think it's an amazing way to be able to help young people learn what other countries look like geographically, what countries look like economically. And I think it just helps us draw people to other people as well, and how we can be a part of that Great Commission as well. So if you guys are interested in any of that, let me know. I know Augie's on this call as well, and he has a lot of trips as well. I highly recommend you guys go. I'm going to go on one of those trips, Augie. I promise you. I don't know exactly when I'm going to make that happen with you, but I promise you I'm going to make one of those trips with you as well. So be a conduit, not a bucket. If you guys are local, our next investor meetup is going to be November 2nd. With Benika Henderson. She's going to be talking about short-term rentals. So if you guys are interested in short-term rentals and you're local to Northwest Indiana, you guys can be at our next meetup group right here in our office, 5:30, November 2nd. Our next call here is going to be with Jim Ingersoll, one of the best friends I have in the whole world. We actually are from the same city, Jamestown, New York, which we didn't know that until we were friends for about 5 or 6 years. But Jim is a great guy. If you look at him on Facebook now, his name is James because somehow his Facebook account got hacked. But Jim is a good guy. He's a guy you definitely want to know. And he'll be our next call, November 21st at 10 a.m. So without further ado, we are going to let David McAlvany have the floor. And then after he's done, he will share the floor with Tory. I know David's got to jump off before 11 o'clock. So if you guys see him jumping off, he does have another prior engagement, but we'll give him plenty of time today to get going. So welcome, David.
Thank you, Tom. It's good to be with you. You know, the investment world is something that we've been interested in as a family for a long time. We're in the asset management business. We've been in business for 51 years, and it's a second generation family business. Our focus has been going back to 1972 on precious metals brokerage, and starting in 2008, asset management in hard assets like infrastructure, global natural resources, precious metals mining companies, things like that. So when I think about the economy, I'm always thinking about it in terms of, you know, where there's opportunities and threats, where there is the potential to make money and where there's potential to lose money. And there's this constant need to balance perspective on risk and reward. When you look at your options to invest, real estate, stocks and bonds, precious metals, cash, your own business, these are your typical places where money can be allocated. And so understanding the context that you're in as an investor is really important, because sometimes those particular categories have either headwinds or tailwinds. So if you're thinking about real estate, if you're thinking about stocks and bonds, if you're thinking about precious metals, even if you're thinking about managing your own business, there's better times to start or not start a business, just given the general environment that you're in. And so that's what I want to spend a little bit of time talking about, is sort of the context that we're in, and what the implications are for real estate. And of course, if you have questions beyond that to the other areas, we can visit about that as well. So who we are, 50 plus years of being in the management business. And I studied philosophy, not finance, but in sort of a self-taught way. I guess what you often learn in life is caught, not taught. And being raised in a family that was interested in finance and managing money for people, there was a lot that happened at the dinner table that I probably took for granted and didn't realize I had as sort of a part of the staple. But philosophy was what I launched into in college, and then came back around to economics and finance in later years. So I'm going to share a couple of slides with you as we get started, just to help with the context, and get this up and running for you. So perhaps start with a little levity. Is that the Washington Monument? Nope, That's our national debt. This becomes really important because here's what we're looking at. We've been on the phone for 17 minutes. 17 times 2, that's $34 million in new debt that's been added to the national debt just since we've been on the line. 2 million a minute. 2 million a minute. That maybe is a better way of thinking of our national debt, because frankly, if you're thinking about billions and trillions, at some point our minds kind of frazzle and you don't even know what it means anymore. But $2 million a minute is consequential. What happens in a day matters. You think this is real money. The national debt's 33.44. We're up over $1 trillion just since the debt ceiling was raised in August. And so, it's kind of mind-bending. 10 years ago, we were at half this number, and we're on track to double again over the next 10 years. And we'll get most of that distance just from the interest that we pay on the national debt, not to mention that we're still accumulating more debt, new obligations, new money that we don't have that we're going to spend anyways. That's sort of the nature of politics is to overpromise, and that's okay, because if you have a printing press, you can get away with it. You can do that. There's long-term consequences, but that's the game that's played. 33.44 trillion, adding 2 million a minute. And this, I think, is a really important quote, and it ties to your understanding in real estate. John Cochran's the senior fellow at Hoover Institute, Stanford University, says this is the tip of the iceberg. The Treasury will also have to refinance all the debt that the Fed's not holding at the same higher interest rates. So what he's getting at is, as interest rates have come up, all the debt that we've been accumulating through the years, it's been financed on very short terms. Mm-hmm. And now with rates higher, because it wasn't financed at 20 and 30-year terms like many corporations did, we have a lot of debt that's rolling over. And as it comes due, the refinancing is at really high numbers. So the Treasury debt isn't that long-term either. The federal government is a lot like a couple that bought a mega mansion they can't really afford and took out an adjustable rate mortgage. If rates stay high for very long, that will start to get very expensive indeed. And here's an idea of what the maturities that we have coming due look like. $14 trillion out of the 30 comes due between now and the end of 2026. Okay, this is really consequential because, today, I'll show you in a minute, today our average interest cost is just under 3% off of an all-time low of 1.56%. It wasn't that long ago that you had some economists, more progressive economists, saying, look, this whole notion that we have to have limits on our debt, that's absurd. And this is what was called modern monetary theory. Modern monetary theory was like, no, you can have any debt you want. Look, we control the interest rates. It doesn't matter. The Japanese are a perfect example. They have debt to GDP figures of 260%. We're running at roughly 100, 120%. No big deal. Well, what they left out of the equation is that they're not in control of setting interest rates. The market is in control of setting interest rates. And now we're in this awkward position of needing to refinance a lot of money. Over 5 trillion this year, 4 trillion next year, just under 3 trillion the year after that. And it's at higher rates. So the average interest cost is that much higher. Again, we were at 1.56%. Now we're at 2.96%. If you can see where this graph takes you. And we expect that over the next 12 to 18 months, we'll average 4%. Why does this even matter? You're like, what's the brass tacks here? Well, we've come up from an average interest cost, which, if you think about all the revenue that the government makes, how do they make money? Taxes. 6% of all government revenue just a few years ago was going to the interest line item. We're on track this year for somewhere between 20 and 25%. It's a big change. And if you think about it, that begins to crowd out the other things the government needs to pay for, things like Social Security, Medicare, Medicaid, the military. education, government employees. I mean, all of these things are a part of the budget. And to have the interest component move up this aggressively puts a tremendous amount of pressure on government finances. And so something that was $250 billion just a few years ago is now over $900 billion. In the calendar year, not the fiscal year, but the calendar year 2023, our debt will be over $1 trillion. That is the interest component will be over $1 trillion. So this year's budget deficit of $2 trillion, $1 trillion of that is money that we didn't have to spend and we just obligated ourselves to spend it anyways. The other $1 trillion is interest. It's interest.
Yeah.
Right? So if the average interest cost continues to rise with interest rates, which it will because we're refinancing debt at considerably higher numbers than we had financed them originally, we're looking at, as I mark here on the chart, $1.3 trillion in interest expense. And on a $4.5 trillion revenue base, that's 30%, up from 6%. Interest rates matter. Interest rates matter for the federal government. Interest rates matter for you as an investor. If you look at real estate, what you have in mind in terms of your interest in real estate are hopes, dreams, ambitions, ideas of financial freedom, things that you desire for yourself, for your family, for future generations. And it's worth keeping in mind, again, what can be either tailwinds or headwinds. Interest rates spent 40 years coming down from 1982 to 2022, roughly 40 years of a declining interest rate trend. That is like jet fuel for asset classes like real estate and stocks and bonds. What you begin to see is a more challenged environment with interest rates on the rise, and it causes you as an investor to have to be much more careful. You can't just throw money at things and see it work out. There are periods of time where dumb money makes a lot of money. And this is not one of those periods of time. You're going to have to be smart about your allocations. You're going to have to be smart about the deals that you do, because the cost of capital is on the rise. The 30-year fixed rate interest rate on a mortgage is now between 7.5% and 8%. That's a number that is not as forgiving as 3%. When money's cheap, you can make more mistakes. When money gets expensive, you're either smart or you're dead. And since you're interested in real estate and it ties to your ambitions and hopes and dreams, I suggest that you do this with very clear eyes and a very clear mind. As interest rates increase, you have to be careful. You're either smart or you're dead. And that's what we're getting ready to face as a country. We have not been smart about how we financed our debt. We've not been smart about the quantity of debt that we've accumulated. And there's some big prices that I think we're getting ready to pay, up to and including significant pressure on the dollar, our currency. So we've talked about the national debt, we've talked about interest rates, we've talked about the rising interest component on the national debt. I won't bore you with these. This is also from the federal government's own numbers, just other deficit figures. Here's something that I think is also relevant for real estate. Let me connect a few dots here with this chart. The white, you see that the U.S. budget deficit, which we talked about and illustrated in a couple of the earlier charts. We expect the budget deficit to be about $2 trillion this year. Now, if you are, I'm pretty sure there's a way of using a laser, but I'm not smart enough to do that. So I'm just going to try to draw your attention. On the far right side of the chart, where you see those white bars dipping down, that's your annual budget deficit, okay? The blue line above it is the U.S. unemployment rate. And very typically, if you look at the correlation, when you have big budget deficits, you also have a rise in unemployment, okay? Now we're running budget deficits that have only been seen during a global pandemic, a global financial crisis, or a world war. Okay, so just keep in mind, this is not normal days. You don't run budget deficits $2 trillion a year unless there's something extraordinary in the backdrop. Now, we're not in a recession today. I can't even tell you what that quote unquote extraordinary backdrop is. All I can tell you is that the budget deficit of this scale, global pandemic, global financial crisis, world war. That's it, right? So something weird is happening here. We're spending way too much money and we're not in the midst of crisis, which would suggest a little bit of caution. If we do end up in a recession and we double down on budget deficit spending, we could be at $3-4 trillion in the budget deficit. Here's the main point that I want to make in terms of real estate. You look at that blue line, and we haven't seen unemployment budge. We have a very strong labor market. If the labor markets break to any degree at all, and this correlation goes back to what it has been normally, where again, big budget deficits would imply pressure in the economy. That pressure in the economy shows up as higher unemployment rates. Now you're talking about pressure in residential real estate. So far, it's commercial that's taken the hit. Commercial real estate's under intense pressure. You've seen 30 to 40% losses, and we're not done there because we've got close to $2 trillion in commercial mortgage real estate paper that has to be refinanced here, and it's tough. It's not going to happen. The numbers don't work. Banks are ending up with a lot of properties that previous owners just are walking away, handing the keys back. Residential real estate has been so strong, and a part of it is the labor market's strong. You know, if you don't see many pink slips, everyone says, look, I can make the mortgage payment, everything's fine. Add to that, because of the quick rise in interest rates, anybody who owns a home is hesitant to move because they know that when they do, they go from a 3-4% mortgage rate to a new property, new rate, and their mortgage, even if it's an equivalent lateral move from one property to the next, their monthly mortgage is going to be double.
Yeah.
So that secondary market product has been off market, and the only thing that is available is from your KB Homes and your major producer, your major developers, right? New construction. So new construction volumes have been fine, but existing homes haven't been selling because nobody wants to move. I don't want to move. I know what my mortgage payment is. I'm happy with it. I don't want to double. No, it's not going to happen. So there's been an artificial lack of supply. Now, to that, what I'm suggesting on the basis of this chart is that you may have a new source of supply, and that is people who are now under pressure financially in the context of job losses. And it's fairly consistent going back to the 70s that when you see high budget deficits, it's an indication of economic pressure, and higher unemployment rates follow. Treasury.
So can I hit that point one more time, Dave, if you don't mind?
Yeah, sure.
You're basically saying that the high debt is a precursor to unemployment. So right now I mean, according to that last chart, we're kind of on that cusp, and unemployment really we should start seeing, higher rates of unemployment, which I think if you're paying attention, you're seeing that already. I mean, I've been telling people, I've had contractors to reach out to me looking for work that haven't worked for me in 5 years. So, it's like, it's maybe not, the data's not there yet to prove it, but like you can see it start to happen.
Well, here's something else to keep in mind. We're coming into an election year, and this is not a partisan comment, but whoever's running for re-election, Republican or Democrat, they make some friendly calls, and numbers always get prettied on the front end. So your headline unemployment figures, your headline inflation numbers, they all look better fourth year of a term coming into re-election. And that's just, those are the games that politicians play. So what you should look at is revisions.
Yes.
So like non-farm payrolls was extraordinarily strong this last week, 336,000 jobs. It blew the doors off the market. Expectations were 200,000 jobs. 336 was phenomenal. Now, just wait a month or two because that'll probably get revised down 150,000 jobs. So you get the big splash, you get the sense of like, wow, everything's great. And then afterwards, you take out the magic pencil. Governments have this thing called a magic pencil within a magic eraser, and you just make those statistics go away.
I'm glad you brought that up, David, because I've been harping on that for like the last couple of months. every revision that we have been getting has been like so statistically off that the people that are doing their job are either doing their job very, very poorly and should be fired, or it's done on purpose. So I'm just going to throw that out there, but I'm going to let you continue, Dave.
Dave, can I ask a quick question on that too? Isn't that correlated to what their objective is? The stated objective is to cool the labor markets. I mean, isn't that what we actually should expect, and why they're keeping rates higher?
Well, yeah, I mean, I haven't even said the magic word for what is sort of one of the defining factors of the last few years, inflation. They want to control inflation and believe that they can control inflation by increasing interest rates. Increasing interest rates puts the brake on the economy up to and including an increase in unemployment. This is intended because inflation, if it stays in an economy too long, can destroy an economy. And so they don't want to flirt with serious ramifications of long-term endemic inflation. So they're raising rates. They're trying to actually they weren't the first to raise rates. The market starts raising rates, and then they've been basically playing catch up. They've not been setting the trend. They've been following the trend set by the markets. But inflation is a significant issue, and it's here for the first time since the 1970s in a real significant way. Even with the doctoring of the CPI numbers, it's a big deal. Just one word on that. The way they construct the consumer price index, this basket of goods that's supposed to be representative of your lifestyle from the 1950s to the 60s to the 70s to the 80s, like a constant lifestyle. What does it cost to maintain the same lifestyle? That's what they're trying to measure. Well, as it turns out, it's not a constant lifestyle. There's all kinds of substitutions. There are all kinds of statistical ways of changing that number. So right now, we've got inflation back under 5%. But if you used the same methodology that was employed in the 1970s, double-digit inflation in the 1970s, which required double-digit interest rates from Paul Volcker to get inflation under control, if you use the 70s methodology, one that was considered very legitimate then, we still have double-digit inflation today. We're not at 5%. We're double-digit. And so, in the teens. So we play with reality, and the statistics, we feel it makes us feel better, but the statistics don't jive with what we have in our encounter in a grocery store or with the bills that we pay. It just, we know what reality is. We live with it. Statisticians, government employees, sometimes they don't. I show this chart here, the Treasury chart. I wanted to show this because these yields from 92 to 2020 are in a downtrend. That's what I was saying earlier is that, interest rates have been coming down. This is like jet fuel for stocks. It's like jet fuel for real estate. It's like jet fuel. And obviously there's volatility. There's moments where real estate might drop and then accelerate to the upside again. But in general, the trend has been down since 82. Now we've broken the downtrend, and this is maybe the most important thing I could share with you. When interest rates shift, it's like the turning of an ocean liner, like that boat we were looking at earlier with Tom. When it takes a long time to turn, but when they turn, it goes the other direction for a long time, as in 2-3 decades. The shortest interest rates trend in U.S. history is a 22-year trend. The longest, we broke the record of 36, 38 years, and now it's over 40 years. So new record, great. But when interest rates turn, they turn for a long period of time. So if you're hoping for tailwinds from cheaper credit, it's going to be in fits and starts. The general trend will be higher, and any temporary relief that you get in terms of interest rates, take advantage of it, because I think that we're looking at decades of gradually increasing interest rates. So that recalibrates how you play real estate and a lot of other investments as well. Again, it just means you've got to be smart in order to not be dead.
Hey, David.
Yeah.
Question here. Like just on a macro level, I mean, prices are not going to go down. I mean, things are not going to get cheaper all of a sudden. Like gas might, but not the production of goods. Once they go up, they don't go back down. So what's going to how do you see that impacting everything?
Yeah, you're right. I mean, when prices go up, they rarely come down. The only thing that will bring prices down is a significant recession or depression, in which case you can see a reduction in price, because people then are all of a sudden worried about losing market share. But if you're looking at a box of cereal, General Mills is not interested. Look, the price of wheat is now down 28% year to date after its major run up after the Russian invasion into Ukraine. Wheat's down 28% year to date. Is your box of Wheaties that hasn't dropped in price? Not at all. So they'll take advantage of that, reprice everything higher, and then we're stuck with it. And by the way, when you look at the CPI, when you look at an inflation rate, it's the change year over year. So we got up to 9%, almost 10% on the official CPI number. Now we're at 5%. Inflation's coming down. No, that's not what it means. Inflation is not coming down. The rate of increase has diminished. Yeah. Means the prices are still rising. They're not rising at as aggressive a rate. But to your point, it's Jonathan, right? To your point, prices are not coming down. Once they reset, they're there until something breaks and the system forces lower prices. So
right, and that's what I'm saying. That's where, like, the people who are buying the inputs, they may get a break as long as they can sustain the prices. Yeah. The only thing that's going to change their price is a major change. So when you think about that, how does that weave into real estate in your mind?
Well, I mean, with real estate, I think it's a little bit of a different function because you're when you're talking about retail goods, the prices are being set by companies and they're constantly pressing for more and more margin. That's not necessarily the case with, I'm thinking of existing homes in particular. Like nobody's pressing for more margin. Of course, if you're a homeowner, you'd like the best price possible when you're going to sell. But it just comes down to supply and demand. So how many people are there to buy and at what price? And the at what price is really key because, if I make 100 grand, 50 grand, 200 grand, whatever it is, there's a certain amount of money that I can spend on a monthly mortgage. And it's either going to be principal and interest, but what makes up those two things is, number one, the price that I'm paying, right, which ends up being converted into the principal, or the interest rate that I'm paying. And the higher the interest rate, the less I can pay in terms of the amount for the home. It's just a cash flow issue. It's a cash flow issue, unless I'm willing to spend 100% of my income on my house. So something has to give. As interest rates have come up from 3 to 7%, it's been like magic. There's been no price depreciation, not to speak of, not in residential.
But you just mentioned, for example, new houses versus existing. Now, the new houses, they have materials that cost money. They've already paid for that stuff. And a lot of that stuff is baked in. You know what I mean?
Yep, it is. I think it's going to come down to, again, how many buyers of new homes do you have and what can they afford? And what can they afford? And so all of a sudden, I don't have the chart with me, but if you look at the National Association of Realtors, they'll put together the average single family home. I think the current is between $407,000 and $408,000 is the new across the country average. Affordability is at the lowest ever in U.S. history. And affordability is a function of the price paid and the mortgage rate on top of it, right? Or affordability is incredibly low, which would imply you're squeezing out a lot of potential buyers. The only way you're going to bring new buyers back in is if either interest rates come down, that would improve affordability, or if the retail sticker price comes down, that would improve affordability. One of those things has got to give for you to bring the masses back. Because I mean, it was in the most recent numbers, I think it was 27% of all purchases were being bought with cash. as investment homes. This is not Joe and Susie Lunchbox buying their first home, dreaming of raising a kid, white picket fence and the tree swing and on the whole bit. This is, either short-term rental or, whatever, but it's investor dollars coming into the market, which is something of an artificial demand input. Doesn't have to be there. Doesn't have to be there. So I'd like to see where real supply and demand is in light of a 7.5% to 8% interest rate. And again, I think one of the X factors is with an increase in the unemployment rate. Now you're talking about pressure on both the demand side, but also new supply coming to market as people just say, well, I don't know if we can stay here, honey. So anyways, I'm not trying to be a bad news bear. I just look at the inputs of too much debt, inflation, and interest rates increasing in order to solve the inflation problem. There's implications, there's knock-on effects. And the knock-on effects are stocks should trade to 30-40% less than what they are currently. Stock market is incredibly vulnerable here, incredibly vulnerable. Real estate has been resilient, not commercial, but residential. And I think it's got some unique characteristics, and they're not necessarily duplicatable going forward. So you've got some vulnerability there too. Doesn't mean I'm not high on the space. Again, it just comes back to be informed, play it smart, or you might be like, bug on a windshield. It's just, but this is it. Dumb money has a fun time accumulating wealth when everyone is making money. Rising tide lifts all boats. We're moving into uncharted territory here with high rates that we haven't seen in 20, 30 years. And that uncharted territory requires a very adept hand on the wheel. If you're going to pilot this and pilot it well, it can be done. There will be people who make tons of money, both in equities, in real estate, but you've got to be smart, really smart. I think one of the best, investments that you can make is in your own education, because that is a part of figuring out how to navigate challenging environments. People are always making money. Always. Doesn't matter what the markets are. Great Depression, 1929 to 1932, there are people making money in equities. 1966 to 1982, one of the worst bear markets in U.S. history, arguably as bad or worse than the 1929 to 1932 period, and people were making money in equities. You just had to be in the right spaces. You had to understand what was happening, and you couldn't be on autopilot. And the market is not there to do you any favors. So engage intelligently, make great decisions, put capital to work when it makes sense, and otherwise be cautious. That doesn't mean, hide out in a bunker someplace. But yeah, I think these become the really, really intriguing times to be an investor. Because
I think you started out the call with this, basically talking about tailwinds, headwinds, and also where does it make sense to put your money. So like today, for many people that are happy with 5%, like they're happy in a money market account today, where they wouldn't even think about putting money in the money market account, 3 or 4 years ago. Obviously at the end of this call, we're going to get to precious metals, which I also think is obviously a place that we should be thinking about hedging right now, where I wouldn't be having these people on my call. When it comes to real estate, though, I think that $400,000 price bandwidth is just not going to make sense for a lot of investors today. And we're going to have to rethink what we're doing and find those areas that maybe we were afraid to go to before, but they're still highly populated, and people will move to there because I think they're going to be forced to move to areas that they wouldn't have rather wanted to with low interest rates. And that's kind of what, how I see this happening and how I see this playing out. And again, I could be wrong, but this is what I've been banking for the last 3 or 4 years. And I really see this coming to a head now. People are buying houses still in Gary, Indiana, and they're not buying in Crown Point because they can't afford the $600,000 house, but they can afford a $200,000 house and a $250,000 house. So people are just going to have to change the way that they think, just because how much money's left over at the end of the month is going to dictate where they can live.
That's right. That's right. Now, I think in light of rising interest rates, again, there's some caution that needs to be applied to stocks, bonds, real estate, and we manage assets in the stock market. I mean, this is not like I'm not shutting down the business. There's money to be made. I just think it's in hard assets. You know, during periods of declining interest rates, financial assets do very well. During periods of rising interest rates, hard assets do very well. I'm talking global natural resources, infrastructure, precious metals, and real estate. The challenge with real estate is that it's a leveraged play, and it distinguishes itself in the hard asset category because of its leverage, which means cost of capital absolutely matters, right? So higher the interest rate goes, the more headwind you have. But again, I don't know if any of you know how to sail. It doesn't matter if you're sailing into the wind or against the wind. It just depends on how you tack and how you manage the sail in order to make forward progress. You can still make forward progress, but you can't do it blindly. You just have to be very deliberate about where and when you trim, when you put your sail out a little bit more, and how you tack, how you move left, how you move right, even sailing into the wind. Okay. So I'm not concerned unless you're on autopilot, and then you should be concerned.
So what do we do if we don't like the data?
What if you do? You put your head in the sand. Go from being a bull to being an ostrich. It's always an option. We live in this world of transitions. Maybe I'm not Dave today. I'm just an ostrich tomorrow. I'm kidding. Probably bad social reference. Yeah, that's the reality is bulls generally make decisions on the basis of a set of emotions where they feel good, they feel jazzed, and they're excited. They're excited about future prospects. They're excited. This is what we started by saying. You're excited because you have ambitions and hopes and dreams, and there's nothing wrong with that. And it's really awkward to sit on a call, maybe this one, and have somebody say, yeah, but it's going to be hard. What you want to hear is it's going to be easy and it's not going to take long. And I'm just a day away from retirement. That's what you want to hear. What I'm saying is that you can still get there. You just have to be smart about it. The bull is looking for easy street. I think today the bearish picture is, look, it's just, the risks are increased with higher interest rates. There's not a lot of room for mistakes. Free money, there's a lot of room for mistakes. As interest rates go higher, you get to see consequence played out in the marketplace. That's why I showed you the chart of US government debt. Interest rates are moving higher. You know what the consequence is? We were at 250 billion in interest payments. Now we're over $1 trillion in interest payments. Interest rates are a measure of consequence in the marketplace. Just got to be careful. I like precious metals. I think they will do very well over the next few years, in part because if the government is trapped and has to continue to issue more debt, they're going to cause a currency crisis. And with a lower valued dollar comes tremendous upside in precious metals. One of the ways you can think about owning precious metals is almost a real estate two-step. There's real estate that you can put in your pocket today, which would be gold and silver. And there comes a point of pressure where maybe you see a discount in stocks, maybe you see a discount in real estate and a premium in your gold ounces. Move on, move out, move to greener pastures. Your ounces serve their purpose. It's like a lifeboat. We don't treat gold as a speculation. We treat it as an insurance policy. If you have hard times ahead, or again, more challenging, environment to navigate. I really like the sailing analogy. If you're going to be sailing into the wind, you may want to have a life vest, lifeboat, what have you. My point is, at some point, you're going to be able to turn those ounces into acres, those ounces into doors, those ounces into shares, because they are assets that do well in an inflationary environment. They're assets that preserve value when stocks are under pressure and when your traditional assets are being called into question. I think it's a great way to look at real estate and say, my real estate ambitions of owning X number of doors, X number of acres, X number of square feet, I get to play a really interesting game here, because if 408 in terms of the national average on real estate is not sustainable, and it's coming down because affordability has to reemerge, and we don't know that interest rates are going to come down. Now, granted, I think interest rates have run so far to the upside so fast. I think we'll see a little bit of reprieve here in the next 30, 60, 90 days. So there's a good case to be made for interest rates coming down on a short-term basis. What I'm talking about is the longer-term pressures that are redefining to the longer-term trends for real estate. And by the way, rates increasing, it's a global issue. It's happening everywhere. We've had inflation globally, and it's interest rates that are increasing all over the world, which is going to impact the total liquidity picture for the world, because as people deal with less wealth in real estate and in stocks and bonds, there's less money flowing around. I think we really are looking at sort of a global recession 2024. And, good news, bad news. If you've just, bought out the years and have no liquidity, you're probably in a tough spot. If you have some liquidity, look at your cap rates. Your cap rates are improving. You don't have to suffer through a 3.5%, 4% cap rate anymore. I mean, you actually think about making real money, not only in a T-bill, the T-bill and chill idea, where you just, park your feet on your desk and collect 5% in a T-bill. That's great. But you can actually earn real money in real estate again. That higher interest rates are good news for someone who's willing to engage with change.
They can be.
Yeah.
Well, I know you only got a couple more minutes left, so I want to make sure that you get to the rest of your slides. Or also, I would like for you to let people know how they can engage with you. I think you have a weekly call.
Yeah, I've done a podcast every week for 16 years. It's one of the longest running podcasts in the country, and we look at financial issues. We look at economic issues. This week, we look at some geopolitical issues. Obviously, the tragic events from the weekend in Israel are consequential to lives, but they're also consequential to interest rate trends and the oil markets and gold. And anyways, those are the kinds of things that will connect on the commentary. It's a world that is interconnected, from public policy and international relations to market pricing. And that's what we try to explore, so that people have context for making wise decisions. McAlvany.com is the website where you can find anything that we do, whether it's the metals or the money management or the free educational resources. Again, it's a labor of love. Probably put in 20 hours a week into preparation for recording the podcast. It's not my primary job. The asset management piece and working with Tory on the precious metals business as well. Those are the primaries. McAlvany.com, McAlvany.com.
I put that in the chat, everybody, so everybody can just click on that, and you guys can get more information about that. I've probably listened to 7 or 8 different podcast episodes. I highly recommend you guys add that to your podcast lists of things that you guys try to engage in. Anything else that you'd like to get across in the next couple minutes that you have before you got to go record your podcast?
No, I'd rather have any questions that are lingering in the group.
So we do have some questions that were put on here. One person said, what is the best way or best resources to better educate yourself on economics and what you're talking about in the direct influence and investments? Any suggestions? So I actually respond to that with your call. So that would be, and you can get on that call, or you can find out more information on McAlvany.com. And then one other person put, how do our economists factor in people being resourceful? Anyone from lower middle class to poor, just to figure things out. They trade under the radar and the like. I see more of this coming.
Yeah, I don't think economists really do factor it in. It's like a conundrum, because it's a non-controlled factor. And in fact, I think it's one of the things that they'd like to sort of get their arms around. If you see the introduction of a central bank digital currency in the next few years, it's because the natural resourcefulness that you see in a lot of communities that force people almost into a black market, if you will, trading neighbor to neighbor, neighborhood to neighborhood, farm to farm. They don't like that. They like everything to be very clean, neat, transparent, et cetera, et cetera. And if I've understood the bit on resourcefulness, and perhaps I'm reading too much into that, but there's the economic statistics don't measure your genius. That's one of the things that I would say, if you ever feel like you're having a bad day, or you're listening to, again, go back to the chart, what if I don't like the data? Just remember that there's brilliant people who are doing brilliant things and making a huge difference. Technology today is allowing us to do things and has created more wealth. Innovation has created more wealth. I've got a book on my desk called Triumph of the Optimists, 101 years of investment returns. Inherently, I am an optimist. I'm not a bear. Even if it sounds like I'm a little bit bearish today, I'm inherently an optimist, in part because I believe in the resourcefulness of people all over this country. When push comes to shove, we get things done. We answer tough questions. We take risk. We innovate. We create. And my hope is not, my hope is in the Lord first and foremost, but my hope is not in government spending, deficit spending, government programs. It is in people like you, created in the image of God, able to create and envision and dream and do. That's a very, very bright future.
That's good. Awesome. I've got one more question. I'll let you go and get Tory on here, but this was from Brent, and I kind of chuckled when I saw this question, because I've asked this question myself at times in the last 3 years. Where's the second place you would live outside of the United States?
Well, I want someplace warm. I live in Colorado. I love the mountains and I love to ski, but I'm 50 next year, and all of a sudden, some reason, the warmth and sunshine and a beach sounds better and better every day. So maybe someplace in the Caribbean. It's pretty close by. It's English speaking. A friend of my dad's, Otto Scott, was a historian, multiple PhDs, and he used to say that in the country that you don't speak the language, you're reduced to the level of a child. So there's many romantic places around the world, but if you don't speak the language, don't end up there. Not really. On a 1 week vacation, that's fine, but to have a second home, no way. I like the Caribbean. It's close. It's warm. It's English speaking.
I think he was asking economically, or politically maybe, but I think that's definitely a good answer. And I know you got to run, David. So thank you so much for spending some time. I would love to get you back on if you're up to it in the next year or so, just talking about your book.
Happy to.
And you kind of alluded to a little bit of a couple things at the dinner table there, about your book. But I think the one thing that kind of hit me, and we didn't have time to talk about the book, but the one thing that hit me the hardest is that most people don't talk about forgiveness when they talk about legacy. And I think that the legacy that you got passed on down to you and that you wanted to express in that book is that sometimes, I shouldn't say sometimes, all the time, family members will disappoint you, and that opportunity to have grace and the opportunity to be able to, pass on that's what I think a lot of the legacy that doesn't get passed on because there's no grace, because there's no forgiveness, because there's none of that. And I'm just going to leave everybody there. I'm just tying that little carrot for everybody to go out and get his book. But I promise you guys will be, I think you guys will be blessed by his book. He did a great job on it. And I'm not just giving lip service to him. I really do think it's the best legacy book I've ever read outside the Bible. So thank you again, David, for your time with us and your investment in our community. I appreciate you, sir.
Thank you, Tom. Appreciate the invite. Look forward to talking about legacy. That'll be a great conversation. Look forward to it.
Thank you, David. So we're going to move over to Tory. I told you guys we're going to have a little bit longer call today. Tory's going to give us an update on the precious metals. So you guys just heard from David saying that he believes right now is a good time to be thinking about this, to be moving money into there. Not from I wrote that down, He doesn't treat gold like a speculation. He treats gold like an insurance policy. And David just, talked about that. Tory just gave us a little bit of an update recently on gold and silver and precious metals at our free for all event. But we've had some changes in this market even since, a couple weeks ago. So David, Tory, you have the floor. Just take the time you need, and we'll have questions at the end.
Great. Thanks, Tom. Really honored to be here. And I think the biggest takeaway from the whole morning and everything Dave said is it sounds like the McAlvany Financial Group is going to have a 6-month Caribbean relocation, right? I mean,
that's what I heard. That's what I heard.
That's right. I'm going to kind of go out
Puerto Rico for tax purposes, maybe. I don't know.
Yeah, there you go. Yep, know some of them. Yeah, it's part of the strategy. So yeah, I mean, I did just give an update at the event, and a lot has changed. I mean, interest rates on mortgages just hit 8% this week, right? That wasn't the case when I was there. And I had somebody just put it really simply, just to tail on Dave's talk here a little bit. And that is a $500,000 house bought at the interest rates from a year and a half ago. You needed a $5,000 a month income. A $500,000 house price doesn't change. You now need over a $10,000 a month income. So he talked about that affordability, and that naturally is going to slow the market down, right? So it's not doomsaying or anything else, but think about that. I mean, at 8% interest rates, that's more than a doubling in terms of where people just were. So anyway, we'll see how that transpires. And on that, I'll share a screen here a little bit, Tom, and just show. I'm going to go a little bit out of order, but we do have single family home prices had a record high increase. So we've got the most expensive housing in the history of the United States. And yet at the same time, we have the record low affordability. So those are, to play off his sailing analogy, those are headwinds. And then finally, I'm going to show you 2 other images here that really kind of explain what's going on in real estate too. David talked about, look, gold is an insurance. It's not the only way to profit in this type of environment. We'll skip around here a little bit, but this chart is a chart of the ProShares Ultra Short Real Estate ETF, right? So there's a movie, there's books written about the Big Short in 2007 and 8 and how people became so wealthy and prospered so greatly by shorting the real estate market. If you guys really believe that that's going to happen, you can hedge accordingly. Look at the performance of this from $15 a share to 22. There's another one here called DRV, the Direction Daily Real Estate Bear. It's a 3x, but that came from 40 up to 68. A 50% increase in the short term on your money. That can also be a good hedge. So anyway, we'll get out of that and get to what I'm here to talk about. But that's just food for thought for everybody in terms of portfolio. And the reason being is there are all sorts of dynamics. Gold is not always the perfect solution. I don't like hearing on the radio or anywhere else that your only choice is gold. It's just not. It's a portion of the portfolio. And so a lot of people are asking me right now, like, why is gold not doing better? We've had a $50 pop in price here in the last 2 days just because of geopolitically. So you'll see here, I put this in my quarterly letter to my clients last week to help explain a little bit the tug of war going on with the metals, right? With the price of gold. It's not just inflation. So people say, well, inflation's higher, gold should be higher. Not necessarily. The bears have a lot of influence, right? So the stronger dollar index, the Federal Reserve tightening, right? Or at least not easing anymore. Stable, strong markets. You've seen a very strong 2023 in terms of the equities markets. Peace obviously is not an issue, but other blue ones, higher interest rates. What starts to whittle away at the popularity of gold is the real rate of return. So if you can go out there and Tom, you alluded to the Treasury bill yield, if you can go get 5% on something and the inflation rate is 4%, well, that's a positive 1% real rate of return. Well, the real inflation rate is not 4% or 3.5 like they would have you believe. It's actually about 8.2%. All right, measured the way it was in the 90s prior to the Clinton administration changing the metrics. Okay, but taking into account the real price of living. David mentioned a couple weeks on a Tuesday morning staff meeting that the cost of living cumulatively has gone up since COVID 18.1% in those years. And I thought, well, we know that's not true, but that's what the government numbers say, right? I went and looked at John Williams' shadow government stats and measured the way it used to be measured. The price of living, the cost of living has doubled in 9 years. So the cumulative effect of now 3 years in a row of double-digit real inflation rates is what we're all feeling. We all feel it. We have to make more. We have to produce more revenue, more income, sell more properties, do better in our investments in order to maintain the same standard of living, right? Or to try to improve the standard of living. It's just taking more. So spiking bond yields is another one. When bond yields are climbing, gold's going down. All right. So the only thing keeping us from getting pulled across the line and going back down to $1,500 gold are things like the geopolitical tensions, the recession, depression concerns, the debt, and the inflation that Dave talked about. They're on the bull side. So I hope that helps explain in an oversimplified fashion why gold just hasn't really taken off and run. And quite honestly, we'll take it. To us, it's an opportunity to get good rates. So here's the quarter and the year so far. All right, not a good picture for gold, but it's also why I said at your event, Tom, that it's about to be time to buy gold. And we did. We finished the quarter very weak. We were about flat. Gold finished the quarter down 6%, silver down 2.7%, platinum and palladium were pretty flat. But looking at the year to date, gold's hanging in there in positive territory after closing. And in fact, this is about right where we were at the close of the quarter. We're right now at 1,862. But silver and the white metals, they're very, very economically sensitive, right? But those white metal swings are what create the ratio opportunities that we're watching. So these don't bother me, right? I mean, if for the silver, platinum, or palladium holder, we've been predicting the palladium. We haven't sold palladium to anybody in more than 3 years because it got so overvalued. So we're happy to see palladium get crushed for the sake of that ratio. But those aren't really good numbers, right? And so what we're looking at here, and please interject, Tom, anytime you got a question, just let me know because I'll get.
Well, I just know that those numbers have gone down since the end of the quarter. So
yeah, they did, and that's what I'm going to show. So this is the chart that I showed at the event, and I was telling everybody don't buy gold yet, right? Because you could see that we're in this channel, and this dark bottom line is called a support line. And my prediction was that we were going to come down and touch that 1860, even though we were at 1950 at the time. Okay. And the reason being is the dollar had started to rally, but the signs were just pointing that way into a weakness. So I said, if you see 1860, then start acquiring at that point. Okay. So what happened since then? The 1860 was what's called a 50% retracement line. Well, we blew right through that. Okay, so we had just a 2-day little pause at that support level, and now we came all the way back down to what's called the 618 Fibonacci retracement. So these Fibonacci retracement numbers aren't perfect, but the beauty of them is that they're naturally occurring in creation. They're part of God's design. I don't know why, but you see that pattern in flowers and nature all over the place, right? Well, you see it in computer algorithms. You see it in trading algorithms. Day traders follow Fibonacci numbers. And so we'll use Fibonacci numbers, not, as a foolproof way of trying to predict a price pullback or a run up, but certainly as a key metric. And it tends to play out very, very accurately most of the time, especially when taking into account other technical analysis. Well, to your point, Tom, we didn't, we were at 1940 at the time of the talk, and that we've come all the way down and we hit 1809 as a low. And these Fibonacci's can be like a range. So 1790 to 1810, that $20 range is really a healthy range. So we did see it, and then we saw a significant bounce. So like I was saying, from the geopolitical strains, we saw a bounce, but we also, drawing out you'll see that over the last 3.5 years, we've had this consolidation pattern in the metals. We've hit the all-time high of 2080 roughly 3 times and have not set a new high, although this one was a little higher in the futures market. That was encouraging. Okay, so we may not be done yet. The further retracement down may be even 1700, right? So that's why I said at 1860, you'll have come off $90, good entry point. Then we see 1810, another good entry point. And I'm not trying to call the low, and I'm also not trying to predict it would come down here. But as you can see, we may absolutely come all the way down another $100 from the low that we just put in. And that can coincide with other market declines because initially gold can get pulled down with it. So why is this going on? Well, again, since September, I talked about that dollar had been rallying. So early on in September, we had seen that little bit of a pop, and it looked like the dollar was going to rally. And sure enough, we went up to 107, and that perfectly, you see how this is the inverse trend of what gold has done. It's not just the US dollar strength, but you'll see here, if we draw this out all the way back to 2021, you'll see how gold up and down. Now you got the dollar up and down, and there's this beautiful inverse relationship or inverse correlation between the dollar index and gold. So when people say, what's gold going to do? The bigger question is, what is the dollar going to do? Right? So the dollar policymakers in Washington, whether it's deficit spending or debt increasing or monetary policy with interest rates, all of that affects the dollar index. But so does the rest of the world. Like Dave was saying, the pound is at a 12-month high. I mean, a 12-month low. The Japanese yen is at an 18-month low. Those are both in the dollar index with the dollar. So when you have other currencies even weaker than ours, it drives the dollar index up. And naturally, between that and bond yields, those are other opportunities for people to either sit in cash or sit in bonds. This is the bond yield chart to that point. So as gold here in just the recent number of months has declined, really start since the beginning of the summer, look at the bond yields. Look at how they have climbed. They've spiked. So people look at bonds as a safe haven, right? So there's, again, another diversification in your portfolio, which I'll get to here in a little bit in terms of how to address the total portfolio. You've got to diversify. If you're 100% real estate or 100% stocks, or even 100% bonds, you're going to suffer the consequences at some point, and that's where diversifying really comes into play. So where's silver? When we were there at the event, silver hadn't broken out of its channel. Gold hadn't yet either, and silver kind of held on and hung in there with the channel. Silver now has come through the channel, broken down, showing significant weakness, and we got down to about $20.50. And now we're back up to $22. So we've had a nice little rally. Well, what ends up happening is that tends to be the case, is that you'll drop and that previous floor becomes a new ceiling. So I think that we're going to have a hard time breaking through that 23 barrier at whatever period of time. The longer this goes on, the higher that price will climb, but you'll be bouncing your head on the ceiling and then trying to find a new floor in silver. And what I'm hoping is that silver drops more than gold and that ratio goes up back into the 90s or 100 plus and gives us another opportunity at a ratio trade, because it does not seem like it wants to go the other direction yet. So we'll be loading up. And
so can you hit that point a little bit? So I know that you guys do a lot of ratio trades back and forth with gold and silver. Mm-hmm. What are those ratios that you're looking for?
Yeah, I'm going to get into that here in a little bit.
Good.
And because I'll show you a good image here in a bit, and I'll talk about just briefly here the silver bounce. So we were under the $21, $20.50. And the other thing that you can look at is this big dip here, okay? And this big dip here, this is the MACD and the RSI, and this is basically an indication of whether something is overbought or oversold. All right. So what it was telling us, screaming at us, is that silver was oversold. And I'll show you that gold was as well. So last week on Golden Rule Radio, I do a weekly YouTube program on the precious metals. And we talked about the fact that it was oversold and we should see a bounce. Unbeknownst to us, Israel was going to happen, right? But despite that, we saw a bounce prior to the Israeli conflict spiking. And so as this started to trend up, sure enough, we're up, $2 and about $2 since that low, $1.75. But we said the same thing with gold, right? There's a few fundamentals that you want to look for in a chart. One, it was oversold and we thought that it was due for a bounce, and it did. It came up to $50. But it also separates from the moving averages. So when you see anything separate that drastically from the moving average, it's going to come back and touch the moving average at some point. It's just the way it is. You see how they cross multiple times here. It's just going to happen. It's not going to stay in perpetuity where a moving average never catches it. So that's another indication to me when we have too big of a move too fast, either to the downside or the upside. You see the same thing to the upside. That's what we're looking for. Okay, so here's the gold silver ratio, Tom, just to kind of give you an update. Back in 2020, when COVID hit, we saw an all-time high of 125 to 1. We had never seen that before. The previous all-time high was 100 to 1. And so we did come back and touch that 100 to 1. But what Tom's alluding to is when we see big price differences between gold and silver, we can sell gold and move into silver, or sell silver and move into gold. And we need a big enough swing to justify that. So here we saw a 62 and it ended up rallying back up over 95. So here's a ratio trade. Here's a ratio trade. We stayed patient, wrote it up, ratio trade, and now we're waiting for that to either come lower or higher, right? So getting into those numbers to answer your question, Tom, really anything above that 60 tends to be sort of definitely have some silver exposure. It doesn't mean do all silver ever. I might do, like in 2020, I did almost all silver. When we saw this spike, we knew that just wasn't going to last. Silver wasn't going to remain that undervalued. So how is this ratio formed? It's taking the gold price and dividing by the silver price. So today it's $1,860 divided by $21.95. And so we're 85 to 1. Okay, which is what that last chart showed. This one's not quite updated, so we're sitting right there.
But extreme highs are 90. Like if you see 90 or above, like you're that's pretty high. That's not
very high.
And then lows, extreme lows, then you're thinking are what, anything below 50?
Yeah, so for in biblically, you'll see a gold silver ratio of about 16 to 1, right? Long-term average in the United States was that. Then the inception of the Federal Reserve, and they started messing with money and metals prices and manipulating, and it grew to about 32 to 1. Now, if I take a 50-year average, it's about 58 to 1. So this dividing line is showing a 40-year average. All right, the 50-year average is actually a little bit lower. So then you can see that it's a climbing wedge. The highs are getting higher, the lows are getting higher. All right, so we can't expect there to be another 16 to 1 like there was back in the 80s. Okay, maybe there will be. We got down to 31 to 1 at the peak of the silver price when silver hit $50 an ounce at the tail end of the price run with the great financial crisis. And so we may see these outlier events, but what I'm interested in is this middle range that you're talking about, Tom, right? That 90 to 50. I love that range because that's enough of a move for us to compound ounces and get the client a net 30% gain. So what are we really trying to do? We're going to start you most likely not 100% ever in one thing, right? But we'll do some gold and some silver because we don't know which direction it's going to go. So if we have exposure to that and some platinum, then now we're kind of got a three-pronged approach to portfolio growth, and it's our job to keep you notified as to when that happens. And by the way, this is going to be something that's going to be available too with our fintech approach. But anyway, if we start with 10 gold coins, and when the ratio swings, it moves us into 7 silver bars, okay, 100-ounce bars. But instead, we hold those for a bit, the ratio swings, and we end up with 15 gold coins. Now this is just a real common example. This actually even happened in 2020. Okay, after that spike to 125, we came back down to 60, and all of my clients that had gotten silver ended up with 50% more ounces of gold. So you didn't put more money in, but you got 5 more ounces. Well, then the gold price went from $1,500 an ounce to 2,080. So you have 15 ounces working for you in a climb instead of just 10. And that's where the compounding effect comes from. And that's where we outperform so many markets, is it doesn't have to be collecting dust, right? And then again, you end up going back to silver, then back to gold. And you'll see that in that round trip, if you give this 10 years, you'll see this natural doubling of ounces over that period of time, just based on, again, these fluctuations in the chart. Okay. Hard to, again, predict timing. They're slow turning ships, I think was a great question that was asked of David. How quickly are these markets moving? Very, very slowly in many instances. Okay. But when that happens, you'll see this is the gold price. Doesn't look like much activity. I'll scale it out for you and show you how well gold has actually performed. Okay. But with ratio trading, you get a much greater return over time. Again, you've got to give it time. Gold has to be a permanent position in your portfolio. And it doesn't matter if it's 1% or 25%, whatever your philosophy is. We know that we're just a small part of any portfolio. Okay. And I showed this. Well, before that, Tom, does that stimulate any questions? Or
Well, I've seen you do this quite a bit. So if there's anybody else that doesn't understand that and you guys have a question about the ratio trading, I didn't realize he was going to go into that so deeply, and I appreciate the explanation. But basically, if to put it on in our terms, like they can literally trade you back and forth from gold to silver. And when David explains this, he says the whole goal is to get more gold.
Yep.
Like it's always about to get more gold. So if you're thinking, okay, what do I want to end up with? I want to end up with more gold. And the only reason why you're trading back into silver is because that ratio, is going to go, a different way. And it's more volatile. The ratio is more volatile than the difference between the dollar and the gold. So you have to think of each one of these things as a different currency, and you're kind of going in and out of a different currency because you know that it's more vulnerable in their ratio trades. So if you were to, the way I look at this is, we only look at gold based on how much it's worth per dollar, right? But if you look at gold and how much it's worth per silver, then that's where the volatility comes in. And I think that's where there's an opportunity to be able to, make that happen. So there is one question here. Is there a minimum investment amount required? So is there I know, Chuck, you were at the free for all. So I'm assuming you did what I asked everybody to do and downloaded the Vaulted app. So you can definitely do this with Vaulted, but on a larger scale, with your help, Tory, is there a minimum amount that you want to have where you're going to work with people on these specific trading ratios?
well, I'll tell you there is not a minimum. However, you do need, a certain number of ounces in order to move into an ounce of gold, right? So I guess a minimum would be maybe $5,000, where you've got an opportunity at an ounce of gold and enough silver to play the ratio, right? To move into an ounce and a half of gold kind of thing. On an IRA, the minimum really should be 10 grand just because of the annual fees. But an ideal structure based on avoiding premiums in the market is to do 50,000, where we can do 1,000-ounce silver bars on the silver side and avoid the coin premiums altogether. So there's a, I know that's kind of 3 answers in one, but it really does matter. Depends on if you're taking possession, if it's stored, if it's in your IRA. But think in terms of those numbers. No, yes, yes.
No, I think it's a good explanation, at least from what I know. But basically, every time you do trade in and out of these, you have to understand there's going to be a fee, and there's different fees depending on how much you have, and the more you have, the less percentage of a fee it is. I mean, is that a good explanation, Tory?
Well, the percentage yes, that is partly true, but the percentage just becomes it tends to be fixed, right? So there's technically a sell and a buy, and you're not getting charged a brokerage fee on the sell, only on the buy. So you guys are already doing this in real estate. And if you step back for a second, think about, oh yeah, I am. When I'm in this market and this market gets overvalued, I'm going to sell at the top of that market because I think that it's overvalued. I'll take advantage of that, and I'm going to find some doors in an undervalued market, right? And so you're increasing the number of doors that you end up with, right, in order to ride that market up and not be exposed to the downturn in the other. So there's a double motivation. It's like a seesaw. We want to jump off the high side and not ride it down. We want to jump onto the one that's undervalued and ride it up. And so you guys can be doing the same thing in real estate. You can be doing it in stocks. This just happens to be my little niche, and following it in your precious metals portfolio the whole time you're diversified into a hard asset that's out of paper altogether, rather than, sitting there doing nothing. Just the spot price over time.
Hey, Chuck, if that answers your question, hopefully it does. But I do think 25, 50 grand is probably a good starting point for most people. And I don't know if you're going to get into percentages of what you think people should have in their overall, but like, I think everybody should be thinking about, just like Tory said, I don't care if it's 1%, I don't care if it's 4%, 5%, 10%. What I see in most people that actually have asset allocation, most people that I know of that have gold at all are somewhere between 5 and 15% of their total allocation. So whatever that is for you, to me, I think you should have something. It should be part of the equation.
I see the same thing, and that's a pretty standard approach. In order for a hedge to work, if something's going to be a hedge, economics 101 will tell you that if you're hedging something, you have to hedge with at least 10% in order for that hedge to minimize downside risk. So right. That for a lot of people is just their feel good number. It just depends, right?
But I think, Tory, just to get into like the emotional part of this, I think people have to believe in it. People have to believe that this is actually a real hedge, and trying to get over that real. Obviously, it's a belief for you, or you wouldn't be doing what you do. But I think that some people have just come to the belief that this is just a commodity, and it's just priced based on what people think it should be worth, not based on like a true real value that goes all the way back in history from the beginning of time.
Right. But I also invest in real estate, right? I mean, I do that too, and equities and the growth. And we'll talk about the triangle. But back in 2005, right here, you'll see price of single family home. Lucky me, I got a place in Phoenix, an investment property in Phoenix, and I rode that guy all the way down. Never did sell it, right? But I was happy for my metals. What this shows is the non-correlation between metals. So even though these are two really pretty charts of what the red line is single family home prices versus gold and how they've climbed over time in similar fashion, they are non-correlated. You'll see a little bit more whipsawing in a pattern here with real estate. But in this dip of the real estate with the financial crisis and the real estate market crash, you can see how your gold was a hedge at that time. Likewise, when gold was coming down here, real estate was coming up. So that non-correlation is really good. And that's why gold is always a part of your portfolio, just like other asset classes. And so I think that we're on the verge of seeing something similar play out here, not to this extreme, but if there is a decline and an incline, then it's far better for you to be sitting in gold than in cash, because you're watching your cash, purchasing power deplete. And if you could have sat in gold during this period of time and then stepped into the housing market right here in 2012, look at how much more purchasing power you had by not sitting in the US dollar. And that's what I try to tell people. And really the vaulted program works really well. So these are those two charts I showed. And this goes to the total portfolio picture, right? Your investment real estate is a growth component of your portfolio. Well, you have two other components. You have a savings and you have the insurance, as David described. So what are your percentages in each side of this? We've done this for 40 years, right? You can be 80% in investment real estate here as your growth factor. I talked to a guy at a conference. It was really neat. He came up to me, just a couple of weeks ago, came up to my table and he's like, hey, I'm a simpleton. I know real estate really, really well. I do 70% of my portfolio is in real estate and 10% is in tithing. 10% is in gold, and 10% is speculative, where I go out and try to score a touchdown or hit a home run. I thought that's kind of neat, but it's still, it all falls into this triangle approach. You know, your cash, your savings position is your liquidity and opportunity. And there's times that you need to be cash heavy, right? And then the growth and income piece, that's where most of the time you do what you do best. And yet the insurance is going to be the hedge that reduces that downside draw in down markets that always come. Okay, so that's how we approach it. We're not saying put all your eggs in the gold basket. So I'm not going to get into this for the sake of time. There are pitfalls in the industry that I would normally walk you through, so I'm not going to do all that. But here's some information for the sake of time, Tom. I want to be sensitive to your timing.
No, I appreciate that. Does anybody have any questions on the gold or precious metals right now that they want to go over? I know we're at 11:30, which is about the latest we ever go. But I think we got it. You must have went through everything perfectly so everybody could understand it the first time. But hey, everybody, this is their contact information. You guys got the McAlvany.com. And then if you guys want to reach Tory, and Tory can walk you through this as well. You know, I'm sure he'd be happy to get on a call with you. One thing you did mention, I did want to bring back out, Tory, was your podcast. You know, we talked about David's podcast. You said you have your own thing that you do every week, and where can we find that at?
Also at McAlvany.com.
Okay.
So we have a whole educational resources portion. We turn out 5, you know, really, really good pieces of content. I'm just one little piece on YouTube with some other advisors here called Golden Rule Radio. And that's on YouTube because we'll oftentimes show charts like I did today. So if you want to know what we're thinking, you know, we're just going to shoot straight. We're not perma bulls. And, you know, just like when I was at the conference, I was predicting the price would come down and to hold off. So listen to me there, but that can be found at McAlvany.com.
That was good. So I appreciate Tory. One thing too, if you get on their list, or I believe if you're a customer of theirs, I think who gets your email updates? Because so like you sent an email out saying, hey, you know, silver's at 87, you know, multiple right now, you know, so it might be something that you might want to, you know, think about. And obviously that wasn't the exact words that you used, but that made me bring more, pull a little bit of money into vaulted and you know, buy a little bit more silver at that point. But who gets on those email updates? Is there like a list you can be a part of to get those, or is that just all your customers get that?
It's my clients. So people
Okay.
that have actually done a little bit of business are going to get my updates. Yep.
Awesome.
Or my email blast. Yep.
So you guys want to be on those email blasts. So let me just tell you that. Any other questions before we go? Well, I'm gonna share my screen then if it lets me. Can you unshare your
Yep.
quick? And then I'll just have a couple. I just want to review what we've got coming up, guys. So if you guys have not joined the Facebook group, please go to the Real Estate Free for All Facebook group and join that. And then also want to remind everybody that's local, the investor meetup group on November 2nd at 5:30 here in the office. And our next call with Jim Ingersoll, November 21st, 10 a.m. And we'll have a bunch of good things to talk about. Jim's always a good guy and a good resource for everybody. Thank you again, Tory, for investing in our community today. Make sure you tell Dave, thanks for being on. And I'd love to have you on again at some point. Tory, you're always straight up guy, and appreciate you for everything that you are and for who you are. So
thank you. God bless everybody. Appreciate the time.
With that being said, remember, guys, to be a conduit, not a bucket, work to have to give. And I'll sign off now. Have everybody have a good day, and God bless. See you next time.